Well, Happy New Year, everyone. Hope you had a wonderful Christmas, and I am definitely looking forward to what 2025 brings us. We are jumping into our first podcast episode of the year, and this is also my seventh year as a financial planner. And I'm pretty sure that the most common question that I've gotten so far in my going on 7 years now as a financial planner is something along the lines of, what are your thoughts about crypto? Some version of that question. So, at the very outset, let me just say that today's episode is not investment advice. The purpose of today's episode is to help you understand some investing principles and some rules to live by. And then you can use these principles to evaluate crypto in particular, but really any type of new trend or speculative investment that comes along. Please consult with a financial professional before making any investment decisions, whether it's related to crypto or anything else. Now, this question about crypto has definitely come in waves. I have not gotten it consistently over the last few years. It really picked up in intensity around, I want to say, 2020, 2021. And then when Bitcoin and other cryptocurrencies took a dive, I wasn't getting the question nearly as much. Strange, right? But over the past few months, all of a sudden there's been this renewed surge in the price of Bitcoin. It recently topped $100,000, and many other cryptocurrencies have similarly hit all-time highs. And so consequently, the interest of investing in crypto has returned. So today I'm going to share some thoughts, some principles, some rules to live by that I bring to investing. And these are, I would say, these are evergreen principles about investing. So we're going to apply them to crypto today, but they would work really, like I said, any type of investment, any type of speculative asset, any new trend. So whenever the next thing, whatever that happens to be, comes along, you can come right back to this episode and take these same 5 points and keep them in mind because they are evergreen. And actually, the place that I want to start, the first principle I want you to consider, has to do with the very nature of investing and speculating. And that's this: speculating does not equal investing. There is a very important difference here. Investing means buying an asset that has a consistent, time-tested track record of increasing in value. So some great examples would be real estate, stocks, bonds, money market funds. So all of those items would have a consistent track record of increasing in value over time and or paying you income in the process. The returns of these types of investments are tied to the fundamental value of the investment. It's not hard to understand why a stock would increase in value over time, or why a bond would be worth something over the long term, because it's paying you interest on a regular basis. Now, that's not to say that all of those investments are equal. Far from it. There are definitely pros and cons to each one of those, but they are very different from speculative assets. And don't overlook this point. By the way, there's a lot of assets that you can buy that depreciate, that go down in value. Just because something is an asset doesn't mean it's a good investment. That's why, generally speaking, vehicles or clothes or electronics or furniture, those are not investments because they almost always go down in value over time. But what would be a speculative asset? Well, that's something that carries both a very high upside, but also high risk of loss. Speculation tends to be very short-term in nature, whereas investing is long-term in nature, and it most closely resembles betting. It's not, I wouldn't say speculating is the exact same as betting, but there are a lot of similarities. So if you were to buy a house, a 20-year treasury bond, or a mutual fund that invests in U.S. stocks, it's very likely that in 20 years from now, that investment is going to be worth more than what you originally paid for it, that you're going to make money on that investment over a 20-year time frame. Now, there is a risk that in 20 years it could be worth less, but historically that risk has been very low. That's why these are investments. But a good example of speculation would be, if you want to go back to the California gold rush, probably the best example in American history of speculation. So remember, back in 1848, gold was discovered at Sutter's Mill, and within a matter of months, we had thousands of people migrating across the country, speculators traveling, hoping to strike it rich. hence the names of San Francisco's football team, the 49ers, because so many people moved to California in 1849. Actually played a big part in making California a state much sooner than it would have been. So it had some good results to it too. But did most of the 49ers strike it rich? Well, no, they didn't. The vast majority did not find gold. A few did, but the interesting thing is that of all those people that came for the gold rush, a lot of them stuck around, even though they struck out on finding gold. And ironically, it was the people who moved to California that didn't go and mine for gold and pan for gold, but rather set up shop and sold equipment and food to the miners at exorbitant prices. They're the ones who actually made most of the money. And I think there's actually a modern day parable in all of that. I mean, but that was speculation. There was a very high upside that, hey, if I get lucky enough to find gold, I could drastically change my financial future very quickly. But there was also a very high risk that they would strike out. So some examples of speculative assets could be artwork or collectibles. Think, Beanie Babies or baseball cards, penny stocks. Those would be like the very small companies that are not listed on the major stock exchanges. And of course, cryptocurrency. Not all speculative assets are the same. Some carry more upside potential, but typically the higher upside potential, the more risk that it carries. So if you are interested in buying crypto, you have to understand that it is much different than buying a mutual fund in your 401k or an investment property. There is no track record of success. It is speculation. So anytime you're thinking about buying something like cryptocurrency, understand the fundamental difference between investing and speculating. Second point, or second rule to live by would be this. Keep speculative assets to no more than 5% of your overall investment allocation. This is really, really important. No matter what it is, whether it's crypto or any of the other type of speculative assets that I mentioned, I would highly encourage you to keep it to no more than 5% of your total money invested. The bulk of your portfolio should be invested on proven, diversified assets, things like index funds and bonds or real estate. When you only put 5% or less of your portfolio in speculative assets, you're really minimizing the impact of potential losses there. And remember, there's a high likelihood of loss in those. And what's going to happen is your investments are going to build wealth steadily over time, and they're going to give you a nice safety net for if those speculative bets fail. And that's why I feel like when I talk to people about crypto or I talk to people about speculative assets, my answer is not necessarily no, don't do that. It's more of, okay, make sure that you're mitigating your exposure. Make sure you're not overextending yourself. And if you follow that 5% rule, then you'll be doing that in that process. So the other great thing is that really allows you to participate in those high risk opportunities. I think some of us like to take big swings. We really want to make sure that, hey, I really believe in cryptocurrency. I really feel like the future is there and I don't want to miss out on that. Okay, great. If you strongly believe in that, if you see the upside there and you want to make sure that you have at least something allocated towards that, I'm not telling you not to do that necessarily, but you want to make sure that you're not jeopardizing your overall financial plan and your long-term return. So you keep it to 5%. Because what's going to happen is once you go in on that, you're on an emotional roller coaster ride. That's just what happens. And you've seen it. If you've invested in crypto before, if you've been in some type of speculative asset, it has its highs and its lows, and your emotions are going to go with it. And when you're feeling that euphoria of, wow, look at how much it's returned in the last 6 months, or you're feeling that like stress and anxiety of, oh my goodness, look at how much it dropped this week, it's going to make it a lot harder to want to stick to a plan. So the positive of the 5% rule is that it allows that allocation to be able to grow and give you some upside without overexposing the rest of your financial plan. And on the negative side, if that does crash, if that crypto investment or whatever else goes to zero, well, guess what? 95% of your money is in stable investments that are going to be doing just fine, and that's going to protect you over the long term. A good scripture verse to keep in mind would be Proverbs 21, verse 5. The plans of the diligent lead surely to abundance, but everyone who is hasty, impulsive, undisciplined comes only to poverty. So there's a real strength in having a disciplined approach and not being not being hasty, not being impulsive. And definitely when it comes to crypto, that can tempt us to want to make very impulsive decisions there. A third rule to live by is this: invest only as much as you would be comfortable losing. And this goes very closely in hand with number two. Think about the money. Let's say that you do have money that's in some type of crypto. What if it were to drop by 50% this month? What if it were to drop by 80%? What if it were to lose all 100%? Here's the question: would you lose sleep over that? If it were to drop 50, 80, if it were to go to zero, would you lose sleep? If the answer is yes, then what that tells me is you've got too much at stake and you need to diversify. So maybe this is the only rule that you needed to hear. Only invest as much as you would be comfortable losing, because that is a very real possibility with these things. So if you're trying to gauge, hey, I've got my 401k, I've got this Roth IRA, I've got some money invested in stocks over here, and I've got some crypto, what kind of balance should I be having here? Should I stop contributing to my 401k? Should I be buying more Bitcoin right now? Well, look at how much you already have. If you were to lose that dollar amount, whatever it's worth right now, tomorrow, if you would lose sleep over that, that probably means you've got too much at stake and you need to diversify. Number 4, don't miss this one. This is a really, really important point to consider, and we've seen this play out several times in the crypto space. Beware the greater fool theory. This is really, really interesting to me. The greater fool theory says, I know that this purchase, this investment seems foolish. I kind of know that in my gut, because what I'm buying isn't really worth what I'm paying for it. But the reason that I'm buying it is I'm making the assumption that a quote unquote greater fool will come along and buy it for more than what I paid, and then I'll happily pocket the difference. And this is how what they call rug pulls go down. And we've seen this quite a few times in the crypto space. Somebody creates a coin, and they and their group, their friends, they hold most of the coins at the beginning. Most of the market cap of that, crypto is held by the creators and that conglomerate, that group. And what they do is they start promoting the coin, and people start to buy, and it's slowly, incrementally pushing the coin's price up. As there's more buyers, as there's more demand, the price is going to go up. And many times, actually, what happens is at the beginning, it's the group themselves that does the early buying. So they create the coin, and then them and their friends start buying. And as that demand comes in, oh, look, the price is going up. Then what they do is they start hyping the fact that the price has already jumped. Hey, look at our meme coin, insert whatever stupid meme of the day is. Wow, it's up 300% in the first week. And analyst so-and-so, who also happens to be my brother-in-law, but don't pay attention to that fact, he says it could be worth 10 times the price that it is now by the end of the month, right? And they get on, whatever Reddit thread or Discord or podcast or, whatever channel they want to market this. And all of a sudden it's like, wow, hey, here's this new coin. It's got a low market cap. Seems like there's a lot of interest and a bunch of people are about to pile in. Let's get in on this early, right? And the other people pile in because they're operating under the greater fool theory. Well, what is this coin? It's nothing. Like we know it's nothing. It's not a physical thing I can display in my home. It's just some digital property that was literally created out of thin air. Why would anybody buy it? There's no intrinsic value. There's no fundamental value. We're buying it because we assume more people will be piling in later, and if we get in early enough, we're going to make a ton of money. And it's essentially the same operating principle as a Ponzi scheme. I mean, it works the same way. The only way that a Ponzi scheme, a pyramid scheme, can work is if you get a lot of people to buy in so that the people at the top of the pyramid can take money out, but you need more and more people to keep coming in so that people higher up the pyramid can get their money. And the people who did get in early enough, they will make money, but the vast majority of people won't because the math is just against you. Most of the people will come in latest, and most of those people will be left holding the bag. Another great scripture to keep in mind when it comes to crypto and just investing in general is Proverbs 14:15. The simple believe anything, but the prudent give thought to their steps. Don't be gullible, don't be naive. We have to be discerning, not just follow trends blindly. Ask yourself, am I buying this, fill in the blank, because I believe in its long-term potential, or am I just hoping to find someone else to pay more? If it's the latter, you are likely playing in to the greater fool theory. And then last rule to live by is have an exit strategy. I've talked to clients before that have a massive amount of their personal wealth tied up in a single stock, and that can be a huge benefit, but also a huge danger. The benefit is, wow, if that stock does well, that can really rocket their personal wealth to a level that would be hard to achieve otherwise, but also they're leaving themselves vulnerable to a lot of their net worth dropping if something were to happen to that one company. And same goes for any type of crypto. What if your speculative investment does work? So let's think positively here for a second. Let's say that you do have some money that you've put in. You bought Bitcoin or Ethereum or XRP or whatever, fill in the blank here. And it has done well. You've actually made a lot of money. What is your exit strategy? What if it is massively successful? What if you already have been massively successful? Then what? What next? Having an exit strategy helps you to lock in those gains and avoid losing your profits due to market volatility, which of course is wild in the crypto space. Without a clear plan, emotions like greed and fear, they're gonna seep in and they're gonna lead to poor decisions. It's gonna make you hold on too long or sell too soon. So what you have to do is you have to define your goals up front and have your exit strategy in mind. Okay? Ask yourself, why am I investing in this? What would success look like in this investment? And set a target for yourself. Okay? I'm going to sell when it doubles. I'm going to sell when it hits this price. Or I'm going to sell at incremental spots. I'm going to sell 25% of my holdings once it reaches here. Then I'm going to sell 50% of my holdings when it gets here. So that you decide ahead of time where your points of success are and what your exit strategy is, and you're not trying to make that determination in the moment. Or another way that people look at this, and a strategy that some people use is, taking kind of the house money approach. Like, I invested $1,000 in this, and now it's gone up to $3,000. I'm going to go ahead and take out my original investment of $1,000. I'm going to go ahead and reinvest it in an index fund. I'm going to reinvest it in something that is stable and long-term and has a very high likelihood of appreciating over time. And I'm going to let the rest of the investment ride, so that even if worst case scenario, it does go to zero, I've recouped my initial investment. All right. So, but whatever that happens to look like, and there's lots of different ways to delineate that and to draw up that exit strategy, but it's really, really important to have that up front, because whenever you're invested in anything that is speculative, FOMO is a very real temptation in all of that, the fear of missing out. And it's going to tempt you to want to hold on to that indefinitely. Well, it did get up to $100, and I know it's dropped down to $40, but I think we're going to get back up to $120. And, so what you have to remind yourself is the gains aren't real until you sell. So, and even really, really promising investments can crash. So create your exit plan when you're in a rational state of mind, when you're not caught up in the hype of this really good recent run. Automate your plan if at all possible, and make sure that you learn from the success stories and or cautionary tales. We've seen this already several times in the last few years. Many investors in whatever, Bitcoin or meme stocks or even NFTs, they may have seen some huge paper gains at first, but then they lost them by holding on too long. I remember seeing one for an NFT is literally a rock. And I'm speaking out of turn because I'm not a crypto aficionado, and I'm not super familiar in the terminology. But it was at a ridiculous price. Like, it was literally an NFT, a digital copy of a rock. That's all it was. And it was, some ridiculous price, and of course now today it's a tiny fraction of that before. Similarly, another NFT for the very first tweet ever on Twitter sold for a few $1,000,000. I don't know what it's going for today, but it's, again, a very, very small fraction of that. So you have to learn from the cautionary tales. Yes, there's been a lot of success stories and people who, bought Bitcoin way back in the day, or like the guy who bought a pizza with his early Bitcoin, like 200 Bitcoin, and I forget how much, I think it was like 200 Bitcoin, and he bought a pizza with it. It was like the very first purchase, and what that would be worth today is like some astronomical sum. So there's flip sides of that too, right? So some people have done very, very well. Others have lost a lot of money. Disciplined investors often say their biggest regret is not having a plan to lock in profits earlier. So have an exit strategy. Selling doesn't mean that you're giving up on future gains. Really, you have to think of it as it's a way to celebrate the success and to secure your financial goals, which is really what this is all about. So I hope those 5 rules to live by are helpful to you. Whether it's crypto or any type of speculative asset or trend, keep these rules in mind and they will serve you well for many years to come. If you have any thoughts or suggestions on other episodes that you'd like to hear or different topics you'd like me to delve into in 2025, I'd love to hear from you. info@nateskelly.com is where you can reach me. Happy 2025, wishing you all the best in this new year, and I'll see you on the next episode.